Friday morning, January 30th, 2026. While most Americans were starting their weekend, a decision was announced that will determine whether your paycheck can buy groceries 3 months from now. President Trump nominated Kevin Warsh to chair the Federal Reserve. The markets reacted, gold crashed, silver plunged, stocks wobbled. But the real story isn't what happened Friday, the real story is what happens in March. Because the playbook Warsh is about to run isn't new, it was tested 50 years ago. And it ended with inflation so severe that a generation of Americans watched their purchasing power evaporate while their wages stayed frozen. The pattern is repeating, the timeline is set, and your paycheck is about to become worth significantly less, not because you're earning less, but because every dollar you earn will buy less. This isn't speculation, this is arithmetic, and the countdown has already started. Let's establish what actually happened. Jerome Powell's term as Federal Reserve Chair expires in May 2026. For months, Trump publicly attacked Powell for not cutting interest rates fast enough. The Department of Justice opened a criminal investigation into Powell over testimony he gave to Congress about renovation costs at the Fed's headquarters. This wasn't normal political pressure. This was a coordinated campaign to remove a Fed chair who refused to subordinate monetary policy to presidential preferences. Powell held firm. He repeatedly stated that the Fed makes decisions based on economic data, not political demands. That resistance made him unacceptable. So Trump selected Kevin Warsh, a former Fed governor who recently called for regime change at the central bank. Warsh criticized Powell for engaging in climate policy discussions, for not cutting rates aggressively, for maintaining what Warsh described as a bloated balance sheet. During his previous tenure at the Fed from 2006 to 2011, Warsh was considered a hawk. He favored higher interest rates to control inflation even when unemployment remained elevated after the 2008 crisis. But recently, Warsh's public statements shifted. He started advocating for lower rates. He began discussing a new accord between the Treasury and the Fed, similar to the 1951 agreement that some interpret as reducing Fed independence. The transformation wasn't subtle. A lifelong inflation hawk suddenly sounding like a dove, and the timing coincided perfectly with Trump's search for a new Fed chair. Markets understood the implication immediately. The mechanics of central banking operate through a simple tool. The Federal Reserve sets the federal funds rate, which is the interest rate banks charge each other for overnight loans. This rate influences every other interest rate in the economy. When the Fed raises rates, borrowing becomes more expensive. Businesses invest less, consumers spend less, economic activity slows, inflation decreases. When the Fed lowers rates, the opposite occurs. Borrowing becomes cheaper, investment increases, spending rises, economic growth accelerates. But if the economy is already running at capacity, if unemployment is already low, if supply chains are already tight, then lowering rates doesn't increase production. It just increases prices. More money chasing the same amount of goods. That's inflation. And right now, in February 2026, the economy is not in recession. Unemployment remains relatively low. Consumer spending is solid. Inflation, while improved from its 2022 peak, still runs above the Fed's 2% target. In this environment, cutting rates aggressively would be gasoline on smoldering embers. The Fed knows this. Powell knows this. But Warsh is about to inherit the job with explicit expectations from the president who nominated him. And here's where history becomes relevant. In 1969, Richard Nixon became president during a period of rising inflation. The Vietnam War had created fiscal pressures. Government spending increased without corresponding tax increases. Prices started climbing. Nixon faced re-election in 1972 and understood that economic performance heavily influences electoral outcomes, so he pressured Federal Reserve Chairman Arthur Burns to keep interest rates low. Burns, appointed by Nixon, complied. The Fed maintained accommodative monetary policy throughout 1971 and 1972. The economy grew. Unemployment fell. Nixon won re-election in a landslide, but the inflation that had been temporarily suppressed came roaring back. By 1974, inflation hit double digits. By 1980, it peaked at 15%. The purchasing power of the dollar collapsed. Workers saw their real wages decline even as nominal wages increased because prices rose faster. The Federal Reserve, under Chairman Paul Volcker, eventually broke inflation's back by raising interest rates to unprecedented levels. The federal funds rate reached 20% in 1981, but the cost was enormous. The economy entered a severe recession, unemployment spiked above 10%, businesses failed, homeowners couldn't afford mortgage payments. The pain required to undo the inflation of the 1970s was far greater than the short-term political gain Nixon achieved by keeping rates low. Economists studied this episode extensively. The consensus conclusion: politically motivated monetary policy creates disasters. The Federal Reserve must remain independent precisely to avoid this trap. Central banks must make unpopular decisions when necessary, even if those decisions hurt the party in power. That principle guided Fed policy for decades, until now. Kevin Warsh takes office in May. His first Federal Open Market Committee meeting as chair will occur in June. Between now and then, economic data will continue arriving. Inflation reports, employment numbers, GDP growth figures. If the data shows continued resilience, which current trends suggest, orthodox monetary policy would maintain rates at their current level or perhaps even consider a slight increase. But Warsh won't follow orthodox policy. He'll cut. Not because the data demands it, but because the political environment demands it. Trump has made his preferences clear. He wants lower rates. He wants economic growth. He wants stock market gains. And he appointed someone who understands those preferences. The first cut will likely be 25 basis points, a quarter percentage point. Markets will rally. Analysts will debate whether the cut was justified. Some will argue that inflation has moderated enough to allow easing. Others will warn that premature cuts risk reigniting price pressures. By the third quarter, another cut, and possibly another. By year-end, the federal funds rate could be a full percentage point lower than it is today, and that's when the consequences begin. Inflation doesn't respond to monetary policy instantly. There are lags. When the Fed cuts rates, businesses don't immediately raise prices. Supply chains don't instantly tighten. But over months, the effects accumulate. Lower interest rates mean cheaper financing for businesses. They expand operations. They hire workers. Labor markets tighten. Wages start rising. Consumers have more income and lower borrowing costs. They spend more. Demand increases across the economy. If supply can increase to match that demand, everything stays balanced. But if supply is constrained, if factories are already running at capacity, if there aren't enough workers to fill new positions, if raw materials are scarce, then the additional demand just pushes prices higher. And in 2026, supply is constrained. The supply chain disruptions from 2020 to 2023 permanently altered global production networks. Companies reshored manufacturing, but capacity hasn't fully rebuilt. Labor force participation remains below pre-pandemic levels. Energy markets remain volatile. Agricultural production faces climate-related challenges. Adding monetary stimulus to this environment doesn't create more goods. It creates more inflation. The timeline matters. Warsh takes office in May. First rate cut likely in June. Effects begin appearing in economic data by September. But the real inflation surge hits early 2027. Why the delay? Because businesses don't change prices daily. Most companies review pricing annually or semi-annually. They sign contracts with suppliers and customers that lock in prices for months. So when costs start rising in late 2026, companies initially absorb those costs. Profit margins shrink. They wait to see if the cost increases are temporary or permanent. By early 2027, it becomes clear the increases are permanent. Contracts get renegotiated, prices get raised, and suddenly, the inflation that seemed under control comes back with force. Your grocery bill, which might increase by 2% in 2026, could increase by 6% in 2027. Gasoline, which costs $3.50 per gallon today, could hit $5 by late 2027. Rent, which might stay flat this year, could jump 8% next year. These aren't wild projections. These are the mathematical consequences of running accommodative monetary policy in an economy that doesn't have spare capacity. Now consider wages. Your paycheck increases through two mechanisms: annual raises from your employer and job switching to higher paying positions. In a tight labor market with rising inflation, wages do eventually rise, but they lag behind prices. When inflation accelerates from 2% to 6%, wages don't instantly jump 4% to compensate. Employers resist wage increases because they cut into profits. They delay raises. They offer one-time bonuses instead of permanent increases. They tell workers that times are tough, and workers who see their expenses rising every month find themselves trapped. The money coming in stays relatively flat while the money going out increases steadily. Real wages, adjusted for inflation, decline. You're working the same hours, performing the same job, getting the same paycheck but affording less. This is the quiet erosion of purchasing power. It doesn't happen overnight. It happens across quarters and years. And by the time workers realize what's occurred, they've lost significant ground. The Federal Reserve's dual mandate requires them to pursue maximum employment and stable prices. When these goals conflict, the Fed must make difficult choices. In 2022 and 2023, the Fed chose to fight inflation even though it meant slower growth and higher unemployment. Powell raised rates aggressively despite political pressure to stop because he understood that letting inflation become entrenched would be worse. It was the right decision. Inflation fell from 9% to around 3% without triggering a severe recession. But under Warsh, the priorities will flip. Employment and growth will take precedence. Stable prices will become secondary. This isn't speculation. This is what Trump has explicitly demanded. And Warsh got the job because he signaled willingness to deliver. The consequence is predictable. Economic growth might look strong in 2026 and early 2027. The stock market might rally. Unemployment might tick down. Trump will declare victory. He'll point to the data and claim his economic policies worked. But underneath, inflation will be building, and when it breaks through, the corrective measures required will be severe. Think about your personal situation. If you're a homeowner with a fixed-rate mortgage, you have some protection. Your housing cost stays constant even as inflation rises. But if you're renting, your lease comes up for renewal every year. Landlords adjust rent to reflect inflation. If your income rises 3% but rent rises 8%, your disposable income just took a significant hit. If you're saving for retirement, inflation erodes the real value of your savings. A 401k might show growth in nominal terms, but if inflation runs at 6% and your returns are 5%, you're actually losing purchasing power. If you're on a fixed income, Social Security benefits do adjust for inflation, but with a lag. Retirees feel the squeeze before the adjustment comes. If you're planning any major purchase, a house, a car, expensive medical procedure, the cost will be higher next year than this year. These aren't abstract economic concepts. These are the daily realities of living through an inflation surge. And the setup for that surge is happening right now. The political economy creates a vicious cycle. The president pressures the Fed to lower rates, the Fed complies, inflation rises, workers struggle, they blame the president for high prices. The president blames the Fed for not cutting rates enough. He demands more cuts. The Fed complies again. Inflation rises further. This cycle continues until something breaks. Either the economy enters recession because consumers and businesses can no longer afford elevated prices, or the Fed finally reverses course and hikes rates dramatically to crush inflation regardless of political consequences. Both outcomes are painful. The first creates mass unemployment. The second creates mass bankruptcies. There is no soft landing once this cycle begins. The only question is which type of crash occurs and when. History offers a roadmap. After Paul Volcker raised rates to 20% in the early 1980s, inflation finally broke. But the recession that resulted was the worst since the Great Depression. Unemployment reached 10.8%, steel mills closed, auto plants shuttered, farm foreclosures spiked. The pain was concentrated among workers who had done nothing wrong except exist in an economy where political leaders had prioritized short-term growth over long-term stability. Those workers paid the price for decisions made years earlier. That pattern is setting up again. The difference is we're currently in the early stage, where the bad decisions are being made, the consequences come later, and the people who will suffer most are the ones with the least flexibility. Low-income workers who can't absorb price increases, fixed-income retirees who can't increase their earnings, small business owners who operate on thin margins. These populations will bear the cost of Kevin Warsh delivering what Donald Trump wants. Now let's talk about asset prices. When inflation rises, different assets respond differently. Cash loses value. A dollar saved today buys less tomorrow. Bonds lose value. When inflation increases, bond yields rise and bond prices fall. If you own long-term treasury bonds, you'll watch their market value decline. Stocks present a mixed picture. Companies that can raise prices faster than their costs increase can maintain profitability. But many companies, especially in competitive industries, cannot raise prices quickly. Their margins compress, earnings fall, stock prices follow. Real estate typically performs well during inflation because property values and rents rise, but if interest rates spike later to combat inflation, real estate can crash as mortgage costs become unaffordable. Commodities generally rise. Oil, copper, agricultural products, these track inflation closely, and precious metals, gold and silver, historically serve as inflation hedges. They don't generate income, they don't have industrial uses that drive their entire value, but they hold purchasing power when currencies lose it. That's why, when inflation becomes a serious concern, capital flows into metals. The Friday that Warsh's nomination was announced, gold and silver crashed. Analysts attributed the decline to a stronger dollar and profit-taking after the metals had reached record highs. But look beyond the surface. The crash occurred in paper markets, in futures contracts and ETFs. Physical metal remained scarce. Dealers reported they couldn't source supply. Premiums on physical coins and bars stayed elevated. This disconnect between paper prices and physical availability suggests manipulation. Large institutions dumped futures contracts to trigger stop losses and force leveraged speculators out of positions. Once the weak hands were flushed, the institutions could accumulate physical metal at lower prices. This pattern has repeated throughout history. Suppress the paper price. Buy the physical metal. Wait for the inevitable rise when inflation proves undeniable. The entities with the longest time horizons and the deepest pockets understand this game. They're positioning now. Retail investors who panic and sell are handing their wealth to those who know what's coming. Central banks have been accumulating gold for years. China added over 200 tons in the past 18 months. Russia continues buying despite sanctions. Even Western central banks, which publicly downplay gold's relevance, maintain substantial reserves. Why? Because central bankers understand monetary history. They know that when confidence in fiat currencies erodes, gold reasserts itself. They know that the monetary experiments of the past 15 years, quantitative easing, zero interest rates, massive deficit spending, cannot continue indefinitely without consequences. They're hedging. If the dollar's reserve status comes into question, if inflation spirals, if geopolitical tensions disrupt trade, gold becomes the universal settlement asset. Silver follows because it's gold's smaller, more volatile sibling. But unlike gold, silver has industrial applications. Solar panels, electronics, medical equipment all require silver. As governments push green energy transitions, silver demand increases structurally. Combine monetary demand with industrial demand, and silver's upside becomes substantial. So what should you do? The temptation is to do nothing. Most people face this information and decide it's too complicated, too uncertain, too far in the future to warrant action. That's exactly the response that ensures wealth transfer from the unprepared to the prepared. The window for action is narrow. Warsh takes office in May. Cuts begin soon after. Inflation starts appearing in data by fall. By early 2027, it's obvious. At that point, everyone rushes to protect themselves. Premiums on physical metal spike. Inventory disappears. Transaction costs increase. The opportunity to position at reasonable prices closes. The smart move happens now. While most people are still debating whether this analysis is correct, even if you're not completely convinced, even if you think there's only a 50% chance this scenario plays out, the asymmetry favors preparation. The cost of being wrong is minimal. The cost of being right and unprepared is severe. First, address your debts. If you carry variable rate debt, credit cards, adjustable rate mortgages, home equity lines of credit, those become more expensive if interest rates rise later to combat inflation. Lock in fixed rates now while they're available. If you have the option to refinance into a fixed rate mortgage, do it. Even if the rate is slightly higher than your current variable rate, the protection against future increases is worth it. Inflation erodes the real value of fixed rate debt. If you borrow $100,000 at 4% fixed and inflation runs at 6%, you're effectively being paid to borrow. The dollars you repay are worth less than the dollars you borrowed. This is how debtors profit during inflation. But only if the debt is fixed rate. Variable rate debt becomes a trap. Second, reevaluate your savings allocation. Cash savings lose purchasing power during inflation. This doesn't mean hold zero cash. You need emergency reserves. But holding a year's worth of expenses in a savings account paying 1% interest while inflation runs at 6% means you're losing 5% per year in real terms. Consider Treasury inflation protected securities tips. These bonds adjust their principal based on the consumer price index. If inflation rises, your principal increases. They're not perfect because the CPI tends to understate true inflation, but they're better than nominal bonds or cash. Another option is Series 1 savings bonds, which also adjust for inflation. There are purchase limits, $10,000 per person per year, but within those limits they offer protection. Third, allocate to hard assets. This is where precious metals enter, not as speculation, not as a get-rich-quick trade, as insurance. If you hold 5 to 10% of your net worth in physical gold and silver, you create a hedge that performs when other assets struggle. The key word is physical, not ETFs, not mining stocks. Physical metal, coins or bars that you store yourself or in a secure allocated storage facility. When you own physical metal, there's no counterparty risk, no bank can freeze it, no government can easily confiscate it, no accounting fraud can make it disappear. It exists independent of the financial system. During the 1970s inflation, gold rose from $35 per ounce to $850. That's a 24-fold increase. Silver went from $1.50 to $50, a 33-fold increase. Those gains didn't happen smoothly. There were crashes and rallies, but the overall trajectory was clear. As inflation destroyed the dollar's purchasing power, capital fled into metals. The same dynamic will occur if inflation returns. The question isn't whether metals will rise. The question is how high and how fast. Fourth, consider your employment situation. If you're currently employed, now is the time to negotiate a raise or seek a higher paying position. Labor markets are still relatively tight. Switching jobs can yield significant income increases. Employers are willing to pay up to attract talent. But if inflation accelerates and the economy weakens, labor markets soften, employers gain leverage, wage growth slows, the time to maximize your income is before the cycle turns. And if you're in a profession or industry particularly vulnerable to inflation, service jobs with fixed pricing, education, healthcare in some cases, consider how you might increase your inflation-adjusted income. Can you add skills that command higher pay? Can you shift into roles where compensation more directly tracks inflation? Fifth, reassess major purchases. If you're planning to buy a house, the calculus becomes complex. On one hand, locking in a fixed-rate mortgage before rates rise again makes sense. On the other hand, if inflation forces the Fed to eventually raise rates dramatically, housing prices could fall as affordability collapses. There's no universal answer. It depends on your local market, your time frame, your flexibility, but understand that waiting might not make houses more affordable. If prices rise with inflation, you're not gaining anything by waiting. The down payment you're saving loses value. The house costs more in nominal terms. You end up in the same relative position for major purchases that will be needed regardless. Buying sooner rather than later often makes sense during inflationary periods. The psychological aspect matters. Watching your purchasing power erode is demoralizing. You work hard, you save, you try to do everything right. And yet, the gap between your income and your expenses widens. This isn't your fault. This is the consequence of systemic decisions made by people who won't bear the costs of those decisions. They'll insulate themselves. Their assets are already diversified. Their income sources are multiple. They have financial advisors who saw this coming. The wealth transfer happens silently. Those who understand the game protect themselves. Those who don't lose. The only defense is knowledge and action. Understand what's happening, understand why it's happening, and position yourself accordingly. Kevin Warsh's appointment isn't the beginning of this story. It's a chapter. The story began when governments decided that endless deficit spending could continue without consequences. When central banks decided they could print trillions of dollars without causing inflation. When political leaders decided that short-term popularity mattered more than long-term stability. Each decision seemed reasonable in isolation. Each solved an immediate problem. But collectively, they created an unstable system that requires constant intervention to avoid collapse. The interventions become more extreme. The distortions become larger. And eventually the system reaches a point where no intervention can maintain the illusion. We're approaching that point. Warsh's tenure might delay it. Cutting rates might create a temporary sugar high, but the underlying problems, the debt, the deficits, the money printing, the political pressure on the Fed, these don't disappear. They intensify. And when the reckoning comes, it will be severe. There's a final consideration. This analysis assumes the system muddles through. That Warsh cuts rates, inflation rises, and eventually someone tries to fix it, but there's a darker possibility. What if the inflation becomes uncontrollable? What if cutting rates now sets off a chain reaction that cannot be stopped? What if we enter a period of stagflation worse than the 1970s, where inflation reaches double digits while growth stalls? In that scenario, the Fed faces an impossible choice. Raise rates to fight inflation and trigger a depression, or keep rates low and let inflation spiral into hyperinflation. Neither outcome is acceptable. But one must be chosen. Historical precedent suggests that central banks eventually choose to fight inflation regardless of cost. They raise rates until something breaks. In the 1980s, that meant massive unemployment. In a modern, highly leveraged economy, it could mean something worse. Corporate bankruptcies on a scale not seen since the Great Depression, sovereign debt crises, currency instability, social unrest. These aren't predictions, these are possibilities that become more likely the longer bad policy continues. Your paycheck isn't gone today, it will still clear this month and next month. The numbers in your bank account will stay the same or maybe even increase. But the purchasing power of those numbers, the actual goods and services you can buy, that's what's at risk. And the erosion begins slowly. A few percent this year, a few more next year. Before you realize what's happened, you're earning the same but living significantly worse. The path to protect yourself exists. It requires making decisions that might seem unconventional, converting some savings into metal, locking in fixed-rate debt, seeking higher income aggressively. But conventional approaches work in conventional times. We're not in conventional times. We're in the window between cause and effect, where the bad policy has been announced, but the consequences haven't fully materialized. Those who act in this window preserve their wealth. Those who wait find that the options have disappeared and the damage is done. The clock is running. Warsh takes office in May, first rate cut likely in June. Inflation data starts turning by September. By March 2027, it will be obvious. That gives you roughly 13 months to position yourself before the full impact hits. Use that time. Because once inflation is entrenched, once your paycheck is demonstrably inadequate, once prices have risen beyond reach, there's no quick solution. There's only the long, painful process of adjustment. And in that adjustment, those who prepared survive. Those who didn't struggle. The choice, for now, remains yours.